that started. All right, I'm just gonna. All right, g'day everyone. My name's Jacob Samuel. I'm using my phone to record it, so my computer's having a bit of a moment and won't let me record stuff. So I'd like to say welcome to the first pretty much applied trading program. It'll be run through Unit, and I'm an experienced trader. If you want any information on my background into trading, I'm more than happy to give that. But pretty much what this course is going to be aimed at doing is going to be giving pretty much an introductory kind of idea into how traders actually do their stuff. We're looking at a lot of technical analysis. I'm not really going to hit up fundamental analysis as much, just because I personally don't believe in it. Some people think that you need to know everything about a stock or an asset before you jump into it. I don't think that's really true. You can just look at the numbers. Numbers don't lie, people lie. So just to provide pretty much a course outline before we get into it. So this first week we're going to be looking at the introductory indicators. Then we're going to be doing 2 weeks on trend analysis. Trend analysis is one of the most important things in investment. So we're going to be looking at stuff like, back checking, making sure that our indicators are correct and how often a trend occurs. Then we're going to be looking at types of investments, so fundamental versus technical. We're going to be doing an introduction to the GMMA model. Very important model for investing. It really is pretty much the only indicator I trust to identify penny stock opportunities. Then we're going to be doing market abnormalities. I believe in week 4, we're going to have the company Perla come in and give a brief discussion about something. From week 6 on, I'd say that's when the course really kicks off, and that's when we'll be moving away from the introductory stuff and into pretty much what we're actually going to be hitting up and what the course is intended. So yeah, let's get into it. Okay, so week 1, we're going to be looking at introductory indicators. We're going to hit it off with stochastics, RSI, MACD, choppiness, and then the money flow. We're also going to be talking about tricks. So when people think about stochastics, they might think about AFIN 270. AFIN 270 is a helpful subject, I guess, in a bit of a fundamental sense. However, it's not really applicable in the real world. When you're doing a stochastics assessment of a stock, you're going to be looking at a graph. There won't be many numbers going on. It pretty much points out buy and sell opportunities because based on overpriced and oversold assets. You can also tie this in with a P&E, profit over earnings analysis. Anything really over 30 is kind of deemed oversold, but we'll go more into that. Okay, so here's a basic example of a stochastics graph. So you'll notice how there's 2 lines. One's a percentage K and the other one's a percentage D, I think. Pretty much what you really want to follow is that orange one. I'd say that's probably the one that I follow the most. You notice how there is 2 sections to it. So you've got this whole section here, and then you've got above 80 and below 20. Between 20 and 80, nothing really happens to the stock. It's a bit of sideways movement, not so much in this graph, but it's not really that great to enter a trend, a stock or an asset at that given time. What you're really looking for is you're looking for above 80 or below 20. So if it's above 80, the price, it's usually deemed as overpriced. So if we go back to here, at this section, the stock is currently placed at 76.5, and this is the Commonwealth Bank. And you can see that if you look at the stochastics, it's pretty close to 100. It's not exactly 100, it's probably around 93-ish. That's really high. So at that point, it's pretty intuitive that you'd want to short the stock. From there, you'd be able to quite easily ride it all the way back down to here. The reason you wouldn't close here is because you've got a bit of sideways movement in stochastic data. You want to really get out of it and go into a buy when you start to see that kind of I guess an upside down triangle, that's what I'd call it, is that section there, that section there. That's really signifying where the trend is kind of changing. And pretty much what you'll do is you'll buy in, where's the mouse? You'll buy in there and then you'll ride it all the way back up again to the top. And then you'll just pretty much rinse and repeat. It's really simple. It's really straightforward. There's no technical stuff to it. Yes?
What website is this?
This is TradingView. It's a website I'd really highly recommend you get used to. I will be going on to it later on. And when we at the end of the class, we'll do pretty much a full-on analysis. I'll grab some live data or even some replayed ones. I've got 3 set up, 2 stocks, a Forex, and I think one other. I'm not too sure. I can't remember. And pretty much what we're going to be doing is pretty much live trading. I've accelerated it, so we won't have to wait, an hour to see results. We'll have to wait 2 minutes, and then we'll see what's going on. So is everyone good with that? With that stochastic graph, so everyone can see what's kind of going on? Mad. All right, let's go into this one. Can anyone just quickly point out to me a buy opportunity? You. Point out a buy opportunity.
Buy opportunity.
Buy opportunity.
The lowest one there.
Go up and point to it, just real quick. Just run.
Around here.
Bang on. Where would you get out of that trade? Just wondering. If you were seeing that, where would you get out, and point to exactly where you'd get in?
This.
Yep. So where exactly would you get in on that, and where would you get out?
I would get in somewhere over here.
Yep. Okay.
The stable trade.
Yep.
No, actually somewhere over here.
Yep. Okay, that's good because you got that upward trend going.
Yeah, and get out because I wouldn't know this point, so I would get out somewhere here.
Okay, the only reason I can say that you wouldn't get out there is because there's no clear breakthrough. There's no clear breakthrough up here. It's close to the line, but however, I would say that it's not really crossed it. So you could potentially even just, stay there. So if you said you got in here, you're still making money even if you ride it all the way up to here, which is fine. You might think, oh, well, it might be time to get out because you've lost a little bit of money. That's fine. Just set a stop loss, and that will prevent you from losing, stupid amount of money. When it rises back up to here, this is kind of your clear, it's time to get out. You've got it reaching it back down to here. You can see that the orange line is still kind of on a curve. It's not, I'd say it's not a sharp depreciation. So pretty much what you can do is that if you wanted to be the risky trader, if you wanted to take that risk, I personally wouldn't, just because I like making money. I would get out there. If you wanted to be a bit ballsy, you could stay. You wouldn't be maximizing your profit though, because it's, as you can see, it started to drop down a bit more. Anyway, so now we have another one. Would you like to point out a buy and sell opportunity, please, and just explain it to me?
Sure.
Yep, just run up real quick.
Cool.
Let's go.
Well, lowest point here. That's going to be
Okay, yep.
So here, because I'm not too sure, but that's definitely.
Okay, yeah. So you're pretty much spot on. Again, you wouldn't do it here, just because you've seen that the blue one's kind of broke. You've seen that the blue one's kind of broken through. That's fine. That could be like, I guess, a 50-50 call for you. It does kind of correlate to the drop. Where's the mouse? It does kind of correlate to that drop. However, you've still got it rising up a bit. So I'd pretty much go off the orange one. I want to really stay in the kind of trade until I get to about this point. I'd be even confident selling here, or even going into a short position. As you can see, there's a pretty strong trend, and you've got pretty much the blue and the red line, the blue and orange are pretty much following the same trend. So that could be a really good short opportunity. I think that this is KRC, so that might ring some bells for some people. KRC was a stock. It's a penny stock in Australia. It went from about 4 cents up to 16. Easily identifiable by stochastics as well. So that opportunity was not hard to see. I might bring that up later. But yeah, so you can see pretty much what is this? Yeah, KRC. So you can see that it's on the New York Stock Exchange. My bad. Sorry. So you can see it's peaked at just above 76.7 cents, and it's just dropped down to 74.1. If you're using a leverage, yep. The main difference, I have it on the first screen, I don't really remember it off the top of my head, is here. So the K percentage is the current market price, current market rate for the currency price, which is the blue, and then the next one is the 3-period moving average of K percentage. Okay, and I guess did we already do that one? Oh, that's just that one kind of extended. So you can see that the downward trend has continued. If you did enter a short position, back up here, sorry. Right, so now we're moving on to the yep.
Sorry, why is the 3-period moving average better than the current market price?
Well, if you're looking at the current market price, I find that is potentially too volatile. I like more of a moving average. It takes more data into consideration instead of just the current market. So you might, potentially if you're looking at the current market, you'll get, obviously the real data, you'll be getting real-time stuff. And sometimes you might find it kind of intuitive that the most recent data is the best. That's not really 100% accurate. You would never do a trade on a 1-minute scale. The reason for that is if you're looking at a 1-minute scale, the 1-minute scale pretty much shows ups and downs a lot. You won't really get a clear, concise idea of the data. Usually I trade on the 30-minute. The reason for 30-minute is it summarizes all that sound is just movement, in that 30-minute period, and pretty much will spit out a candle. A candle pretty much gives you the story of what's going on. It's much like, I guess, a chapter in a book. And it would just tell you what investors are doing, if it's a buy or sell period, and if you really want to go into it, you can learn the specifics of the candle. I'll just get to you in a sec. So you'll notice how there are tails going up and down. There is a method that you can use. It's called candle analysis. You can go into that more. I'm not a big fan of it just because there's so many different types of candles and different situations. It's a bit hard to memorize all of them. I prefer these technical analysis where you can just kind of read a graph and see what's going on. You had a question?
So the candle analysis is the top graph?
Yeah, so this one is a candle analysis. So you notice in most situations how it's just a line. I find the line really useless. Great, you're looking at a single line that doesn't really tell you anything. If you're looking at these candles, you can kind of see where, positive and negative growth are. That might seem like you can just read that off a graph. You can and can't really. So with a line graph, you might get something like this blue line that's going past here. That would be, it's not really, I'll just bring one up, sorry. That might just be the easiest thing to do. So this is the program that I was talking about, and we'll just change it from candles to line. So here we have a line. It doesn't really tell us much about actually what's going on. You can see that there are drops and there are peaks. However, when you start to get into technical analysis and you start to try and compare that with, say, stochastics, which is what we're using right now, you can kind of tee it up, but I just prefer, and I think it's a lot clearer. That's on the day, sorry. Yeah, I just find it a lot clearer and just a lot easier to read it. That's just my personal opinion. Yep.
I'm sorry, also the 3-period average, that's every 30 minutes?
No, so it usually considers 3 days.
Okay.
And we'll just go from here. So now we're going to move on to the RSI. The RSI is I guess you'd say it's one of the first indicators that was ever made. So by that, it's been tested countless times. It has a lot of unique properties. There's the formula if you're really interested in it. One of the big things that you'll see soon is you might immediately think it's just like stochastics. I mean, it looks the exact same. It shows overpriced and oversold asset. So why is it not like stochastics? Well, the RSI shows, I guess, momentum and the strength of the trend, whereas stochastic just shows overpriced and undersold. Overpriced and oversold, sorry. So here we have General Motors. Now what we've got is we've pretty much got the strength of the downward trend. So here it is probably the most clear. So you've got it above, it's clearly oversold. Well, not I wouldn't say clearly, but it is oversold. And you've started to get the downward movement. Now it's dropped all the way down. Now that's probably 5, I'd say, a rating of 5 on the RSI. So that means there's been a very strong downward trend. Now how can you identify that? Because we're looking at data that's already happened. Well, your first real indication would potentially come, I'd say, here. That would potentially be your first real indication of kind of that if you missed it up here. If you missed this would be your, it's time to go. You could easily short that and you just ride it all the way down. Then you started to get, just like stochastics, you started to get that direct move back up. Down here, that would be your chance to, again, get back in. So I'm just going to grab one of you and pretty much just ask you just to do what the other two blokes have done. Go on the green jumper. Would you just be able to point out a buy or sell?
I don't know, this looks nice and low.
That does look nice and low, yeah.
Like a big gap between
Yeah, absolutely, absolutely. So what we've got here, so she's just pointed out this section here. Now that does correlate with the data drop. It's not the strongest of trends. It hasn't really, well, if you go back here, it probably does go above it. So we do have a bit of a zigzag kind of line going down to here, but then we have a really sharp, that's really a really sharp increase in the data. So what that's starting to signal is it's starting to signal this is time to buy. This is time to get into this stock. It's not curved, it's sharp. When you see sharp trends like this, it's time to start thinking about either getting in or getting out. And then what we don't have is we don't have it really going above that oversold price until here. But this is what we call a false or a fault. There's a technical name for it, but I've just forgotten, so I'm just going to call it a fault. Fake out, that's what it's called. So this one is a great example of that, fake out. So what's happened is it's kind of like it's done a bit of a peekaboo over, I guess that's what you'd call it. And then it's just dropped back down. So the data's still fine. And then here you actually have your first kind of breakthrough. And you can see that happening here. And then it started to go, well, we're overbought, we're overpriced. Investors aren't going to get into this. It's uninvestable or not an opportunity for someone to go and invest their money. It's overpriced. It's too expensive. So investors are going to go, well, I don't want to get into that. I'm going to go and look at maybe AVZ, or I'm going to go look at Apple. So they're going to get out. And then what happens is you get a really strong trend downwards. It doesn't really break there. It continues to travel, then it breaks again, and then you've pretty much got the reset of the trend again. And that's rinse and repeat. It's the same kind of idea as stochastics, except it just shows, I guess, the trend strength instead of just overbought and oversold. I guess probably the best thing that I have to say is use them in combinations. If you're using a stochastic analysis to kind of show overbought and oversold, the RSI can allow you to see the strength of a downward movement if it's oversold, or the strength of an upward trend if it's overbought. And that way you can really take advantage of, I guess, market abnormalities if you're doing penny stocks, or you could just do rapid trading on an index or Forex, or pretty much any asset. You know, the RSI and the stochastics are very unique in the way that they do work for everything. So I'd encourage you to definitely start trading with them if you're going to start doing something. So unlike stochastics, RSI has a very special situation in which I'd say that if you do see it, it's definitely a signal to get in or to get out or to short. It's called divergence. So divergence happens when, picture the stock graph, if you've got a high point, then the stock has risen to another high point, but on your RSI, it's gone from high to low. Does that kind of make sense? We'll see a graph of it anyway. So a great example is here. So what we have is this would be considered a high point as it's higher than that one. That one's lower. But then what we have here is this is low and that's high. They're opposites. Now what does that mean? That's divergence. So the RSI is not correlating with your stock analysis. It's with your candles, sorry. So what that means, it means that there's a weakening in that trend. So currently what we have here is we have a downward trend. It's not very noticeable, but it is downward. The stock is going down. Then we've got divergence. The divergence will be the first indication to go, okay, there's a weakening in the downward trend. There's going to be an appreciation. You wouldn't necessarily see this on stochastics. It does occur, however, not as commonly as in the RSI model. Because it doesn't occur very often, like I had to look, I wouldn't say very hard, but I had to spend more than 5 minutes looking for this. So it doesn't occur very often. It's because it doesn't occur very often, it's deemed more reliable. So the more of these you can see, the more obviously easily you can identify buy and sell opportunity, and you can pretty much invest and easily get out from there. So that was a bullish. This is a bearish. So pretty much what we have is pretty much the exact same situation. It is around here, and yeah. So we got a high there, and then it's gone. No, sorry, 1 second. Low to high. Yeah, so it's gone from a low to high, and then you've got that the divergence that's occurring right around here, and it's gone straight into a downward trend, and then it's reached below the 20 mark, then it's shot back up. Moving on to the next one. Now this is the MACD. MACD is one of the I'd say it's one of the fundamental tools in investing. Personally, I don't use it. I don't really like it. A lot of people do though, so that's why I'm teaching it. It's called the moving average convergence and divergence. There's three components to the MACD. There's the MACD line, which is the difference between the two moving averages, those being a 12 and 26-day moving average. So those, as mentioned before, with the stochastics, they take into consideration the last 26 and 12 days. What we have then is we have a signal line, just a 9-day exponential moving average. Now the difference between a moving average and an exponential moving average is obviously the exponential. But if you're ever going to use a moving average in any sense of anything by its own, as moving average is an indicator, I would strongly recommend that you don't, and that you use an exponential moving average instead. Moving averages just follow the trend of the data. It will pretty much closely follow, I'll bring it up actually, that just might be easier. So yeah, as you can see, it pretty much just, it very closely follows the data. It's not that helpful. You can't really see any clear buy or sell opportunities. And even if you do stack them into different time periods, so this is currently on a 9-day. If you use it on a 9-day, you don't really see anything. You can add extras to go like 9, 18, 27, 36, and then that might give you a better idea of how to do it, but it's kind of a bad version of a GMMA, which we'll go into in the next coming weeks. So I wouldn't recommend using a moving average for anything really ever. Does anyone know how to start from like the current slide? Is it F5? Oh, thanks, Reese. Bloody useless. You're useless, man. You know that. All right. So there are 1, 2, 3, 4. Okay, so there are 4 situations with MACD which you need to understand before you actually start using the MACD. First one, most obvious, is a crossover. That occurs when your MACD crosses the signal line or when the signal line crosses the MACD. That will pretty much show a buy or sell opportunity. Depending on which it's crossing, you'll be able to easily see. Now, fake out, this is what I was talking before. It occurs when it looks like they're going to cross. It looks like when the line is going to cut through something, but it just doesn't. And this tricks a lot of investors because you might see that on a very sharp downward trend. It looks like it's going to cut. Don't ever assume in investing. You will lose money 100%. Wait for the data. It doesn't matter if you miss out on a few dollars. I'd rather miss out on a few dollars than lose a few grand, you know? So be careful of fake outs, 100%. Next, you got is the center line method. So in the MACD, a line just crosses straight through the center of the graph. Pretty much what it does is when lines cut through that, it's at 0, and that's an indication that the trend is pretty much changing. Now the next one is divergence, very similar to the RSI divergence. It's pretty much when the MACD does not match up with the candle data. So when it doesn't match up, and there's an example, a real example right there, when it doesn't match up, that's a weakening in the trend, and pretty much that is your time to pretty much buy and sell, depending on what the data's saying. The final one is a bit more for market abnormalities, dramatic rise or fall. And that's pretty self-explanatory as to what that is. I'll be uploading this whole lecture slide online if anyone wants to reference it for future. You don't have to go and watch the whole thing if you just want to see one particular slide. Anyway, so on to some examples. Forward, okay. So this pretty much is what the MACD looks like. So again, did I say what's what? No, I didn't. That was a bit retarded. Anyway. So again, we have the signal line and the MACD line, then we also have the histogram. Now, histogram is really important. It's really important. It's something that you want to look for. It pretty much shows the difference between those two lines. So again, it shows strength of a trend. So if you're looking, say here, you've got that. This here's the crossover. This here's the middle point. You going?
Yeah,
Oh, all right, so this pretty much shows what we're talking about, the center point analysis. So you've got the crossover here. That is your first indication to go, okay, there's an upward trend. It's time to potentially get in. Now, if you were just looking at the MACD and signal line, you could maybe get confused. This here is your, I guess, not 100%. I don't ever want to say 100% because obviously markets can rapidly change, but it's a 99% good idea to try and get into that when you see this kind of this flat area. Now, if you didn't want to get into there because you might go, oh, it could be a fake out situation, you could quite easily just wait a little bit, maybe set it to half an hour, wait 2 hours, just see how this histogram is panning out. Is it looking something like this, or do we have these massive straightaway lines? If you got something like this is a great example. So you've got a small little line, small little bump in the histogram, and then you've got several really exponential massive ones which follow. And that is really showing the strength of that trend. And you've got the point here as well, and you've got, yeah, it's just really easy to see. It's really good data. Yes, mate?
Why use the RSI then if that histogram also shows the strength of the trend? Use the RSI.
Yep. So one big thing that I always have is that you never use one indicator to kind of inform yourself. So if I said, hey mate, we're gonna go to the gym, I can bench 300, I clearly can't. But you don't know that. If I had a video of me saying I bench 300, you'd go, all right, you bench 300. The RSI is it's saying I bench 300. The MACD is backing it up, saying, hey, here's a video of me benching 300. Okay? So if it's the same thing with stochastics. It does pretty much the same thing as the RSI and the MACD, but it's just backing it up. You know, you wouldn't just look at one thing and just go, oh, this is everything. You know, that's like it's like going to a news channel saying there was, I don't know, what's a good example of a news thing? There was a crash in the M5. Let's say there's a crash on the M5. You wouldn't just look at 9 News, even though 9 News is really reliable. You wouldn't just look at it. You might go and have a look at some other things, say, if, you know, to really kind of back up that and say that there actually was a crash. You know, if you want to actually, especially when you're dealing with money, you don't just want one thing signaling. You want 5, you want 6, you want as many as possible. Like with my current investment strategy, I'm using 8 indicators, which pretty much all say the same thing. I'll pull that up just so you can have a real quick look at it, what I currently do. And it shows pretty much they're all saying the exact same thing. They're all modified versions of stochastics and RSI and MACD. Everything pretty much shows the same stuff. It's just different ways. And that's really what you want in an investment strategy. No worries, mate. You're welcome. So this is the divergence. Now, divergence, again, really important. Now, what we have here, you've got a low to a low. That's fine. You can see that it's on a downward trend pretty clearly. You don't even really have to do a real kind of an analysis to kind of see that. You can just look at the graph and just kind of know. But what you have here on the MACD is an upward trend. That is signaling that the strength of the downward trend is weakening. That is your time to buy. Now, what you have here is you have your crossover. You've got your first crossover, your second, and your third. Now, many people might see this one and get excited. They might go, damn, it is time for me to get into this stock at this crossover because there's going to be a short. It's going to be a clear short opportunity. There's a crossover. The MACD is showing, showing a few bumps, but nothing too great. This is going back to the point that you made then. Why would we use an indicator that just shows the same thing? This is exactly why. Because you want to be able to see that it's not going to be a short opportunity. If you're just using the MACD, you potentially short this. You might go away on holidays for a few days and come back and be like, oh, I should have lost 30 grand. You know, like that kind of stuff does happen. But with these other indicators, you'll be able to see pretty much how different opportunities work. And I will, at the end of the class, obviously pull up a page with a stock or a Forex or whatever, and we will actually be able to look at how all these indicators kind of work together and kind of support each other. So we've got this divergence period here. This here is just a straight trend line. They're not that hard to make. You just go from a low to a low. We'll be going through trend lines next week. Really encourage you to come to that because that's really important. But anyway, moving on to this. So we've got the first crossover here. You could potentially get in here. That there would be more than acceptable. And then if you wanted to, you could close. You could definitely close here. You wouldn't make a huge amount of money, but you'd still make a few dollars. You could short if you really wanted to, and then wait for the crossover here, or you could just potentially just buy in here, brace for a little bit of a loss, and then make that all back as the trend continues to go on. Again, it's much less common than the other ones that we talked about. However, because it is less common, it's more reliable. That's not the case on everything. Obviously use your other indicators as well, but it's a pretty good idea of how to articulate the market. Okay, choppiness index. When people hear choppiness, they go, why would I want something to tell me something I can see? Why would I want to know if a stock is choppy? The reason is because the choppiness indicator is really, it kind of points out maybe not as obvious sideways movement. Sideways movement is never good. It's pretty much the stock not really knowing what it wants to do. Well, it kind of knows what it wants to do. It just wants to go sideways. No one really makes money. There is the opportunity to make money on the shorts and buy periods. However, you'll be doing them on a 30-minute scale, so your profits won't be that great. The choppiness indicator will pretty much tell you, is this an ideal stock for me to get into? The closer the value is to 100, most graphs show it only as 60 though. The closer it is to that, it means it's more choppy, which means it's higher sideways movement. It means it's not ideal for you to get into. If it's closer to 0, it's very strong. It's on that strong trend. And this is where you could use your RSI, your MACD to identify what the trend is. So if it's, say you've got a choppiness index of say 20, that's pretty strong. It's close to 0. It's really far away from 100. So what you can do is you're going to be knowing, okay, bang, I got it. There's a strong trend. Which way is it going? Let's look at the RSI, let's look at the MACD, let's look at stochastics and kind of identify where that trend is going. Is it a downward trend? If it's downward and it's near 20, choppiness index is near 20, you go, bang, I can get on this. I can quite easily make some money. And you just wait for the choppiness index to rise back up to 100. You go, I don't want to be in this anymore. I'm not going to make any money. Let's get out. First, does anyone have any questions so far? Yes?
Yeah. What's generally your thing on what's your range of like what's choppy to what's not? Like,
Yep. Well, we'll show on the next page actually. So 40 to about 65. I don't really get into. Is that 40? Yeah, well, 20, 38-ish, but yeah, around there. You can kind of customize it depending on the stock, which we'll go into a bit. But usually that's kind of for me. 40 to about 60-ish is kind of the point where I go, okay, I don't really want to be in this kind of stock. It's not going anywhere. It's not great. Like, you can still get in, but it's just not great. So I will pull someone up just quickly to ask. Gunj, would you like to?
A question?
Yeah, just pull up. Just pick out where you think you would get in and get out. Just quickly, just run up. Just make it easy. Let's go. So this I guess is kind of saying where would you see you wouldn't get in? Point out where you wouldn't. Okay, yeah, definitely 100% you would not get in there. Where would you get in though? Can you see an opportunity there where you would get in? Okay, well, that's good. It's kind of right, not really. The reason you wouldn't get in on this one is because there's no clear indication. You can even just look at, you just don't even have to look at the choppiness, but if you did, you can just kind of tell that there's no real indication. All of this is just kind of hanging around that 45 to 38 comes down any lower. So I guess your real indication to getting in would probably come potentially around here if your other indicators were saying get in, but just using the choppiness index is telling you that it's probably not the best stock to get into. So on this one, this is not a great stock. I would look at this, I'd go, okay, I hate this. I don't like anything about this. I don't want to be in it. I'm going to move on to the next one. I'll kick it to the curb. Next one, this one. Really easy to see where we want to get in. Now, this one, obviously, it's between 60 and 20. That's just because the data doesn't go as high as 100. It does expand if there's more movement. So I'm going to grab someone else, just really point out an opportunity. Bloke in the red jumper, would you like to just quickly, yep. Would you just like to quickly point out to me an opportunity where you want to get in and where you wouldn't? So we'll go where you wouldn't first. Where wouldn't you want to be? If you were going to look at this stock to get in, where wouldn't you want to get in?
Here.
Absolutely, and where would you?
I'll get in here.
Yep. Okay, the first one you wouldn't want to get into, or well, you could, but it wouldn't be for very long. You pointed out the more ideal one is straight down here. You could even potentially get in here. Even if you wanted to, I'd probably even think about getting in here, but very good, very good. The reason you'd want to get in here is because this is the first indication, the first kind of indication of it's time to get in. The stock is actually going somewhere. We have something that's going to be moving up and down or in just an upward direction. Of course, your other indicators will tell you what the direction is. If you didn't decide to get in there because it is still very close to that 40 mark, you might not be that confident of an investor or you might not want to take the risk. You can obviously just wait a little bit. You won't miss that much because it does go back into that, it's getting to that stable bit just between here and here. If you wanted to, you could get into here. You could get in here, here. Here you probably wouldn't get in there just because it's getting too close, and I'd say really after that point onwards, you've missed your opportunity to get in until it comes back down here. Up here, the choppiness index doesn't tell you whether or not to get in. It doesn't tell you when to buy and when to sell. It tells you if the opportunity exists. So that's one thing that I need to make really clear. It doesn't work like a stochastics. It doesn't tell you if the stock is overpriced or underpriced. It will tell you, yes, this stock is viable. Yes, we can get into it, or no, we shouldn't because there's just not enough movement going on. And yeah, that's something that's really clear. Again, we have another opportunity. It's not as great, but I will grab another person. Dude, the black that's been asking questions. Kind of annoying. No, I'm joking. All right. Come up and I want you to point out an opportunity where you believe you would not want to be in. So we want to find one where we don't want to be in. Where would you say it? Okay, so you said right here and you were bang on the money, man. Yeah. Like, that's perfect. Okay, so now I say, I want to be in this. I want to be in it. Where would you point out?
There.
Okay, and I'm just going to ask you a random question as well. Looking at that, what's the trend saying? Just that your candles, what's it saying?
That one's a little bit beyond me.
Okay, that's fine. That's not a problem. Okay, so we can look at the red candle here and saying it's a downward trend. Yeah, we can do that quite easy. So obviously red means up, green means up, red means down. Yeah, I'm trying to stuff you up, man. Sorry, mate, but very good. Thank you very much. All right, so as you said, what's your name, mate? Sorry?
Chad.
Chad said that we can get in down here and we probably don't want to be up here. That is absolutely correct. He could have also chosen No, he couldn't have. That's the best he could have done. Thank you very much. Good job. Okay, now we're moving on to the MFI, Money Flow Index. Another very important indicator. It pretty much works the same way to the MACD. Again, it's an oscillator that uses both price and volume to measure buy and sell pressure. Now, one thing I do want to make very clear, when people say volume, they go a bit, oh, well, people are trading this stock, I want to get into it. No. Volume is not a really good indicator of whether you want to get in or get out, because volume is delayed. All indicators are delayed, but volume, say there's 50 million people are buying OGX. That's a massive amount of people buying OGX. It's going to go right up. But when there's 50 million people that bought OGX, what do you think is going to happen? Are you going to be the person that's going to get in before that person, the 50 million people have bought, or after? Because you're using a volume indicator, you're going to probably be the person that gets in after. You're not going to be as successful in that trade if you're using just a volume indicator. So that's why personally I don't really like them. And I'd like to use this kind of stuff. Oh, they must know everything. Okay. So now we've got our obvious cases. Now the reason I say obvious is because they're clear. There are less obvious cases, which we will go into, but we'll stick with the obvious for the first one. Okay, so we have it it's presented just like stochastics, and I really like ones that show these regions not to get into. It's very easy to see. I find it very easy to read. Again, I'm pretty sure this one's customizable, but I'm not 100%. I haven't used it for a while. But anyway, doesn't matter. It's still a really good indicator. Okay, now this is Orikino Gold, OGX, massive stock. Probably one of my more successful trades. So it's about 1.9 cents there. And we have it shoot all the way up to 13. That's phenomenal. If you got in, just even put $1,000 there, you'd make ridiculous amounts of money. Just $1,000. So yeah, you can make quite a lot of money even if you don't put in a lot. If you're buying directly through like CommBank and you put $1,000 in, that's fine. You'll make a bit of money. If you're doing it through say IG, which uses leverage of 1 to 20, leverage is a beautiful thing. Get amongst it. So leverage range usually go from 1 to 20 for stock, 1 to 300 for Forex, 1 to 300 for indices. I've seen 1 to 400 for crypto on some crypto specialist websites, but usually it's 1 to 20 because most people don't have trust in it. I'm one of those people. So if we're looking at this and you're using leverage and you're investing $1,000, you're actually investing $20,000. That might sound like a lot. It's not. Pump 20 grand into a stock, the movements won't be that massive. On the depreciative scale before you get your opportunity, your signal to sell. Anyway, so let's look at this one. Where can we see an obvious buy situation? Well, we can see one right here. It's below 20. Now, it's not hugely below 20, and you need to take that into consideration when you're doing penny stocks. So this is a penny stock. It's not like a very clear one. It's not like 0.5 or something like that. It has definitely broken through. It's quite a wide margin, I'd say, between 20 to 80. Usually, I would set it to 30 to 70. You still want to capture those abnormalities, and this kind of, I guess you could say, ignores them, which is not ideal. But it is the default setting. So what we have here is, some of you will have noticed this number here, this number next to the indicator, and I probably should have gone through it with every single one. And that's how much data it considers. So this is considering 14 days worth of data, which is pretty good. When you set it to, say, something like 100, you're going to get a very odd result. So be cautious with how much data you want it to consider, usually between 14 to 20, yes.
With leverage, what are your potential losses? Is it unlimited or?
Well, see, your potential losses are technically unlimited, yes. However, you can avoid losing massively, and that's just because of the beautiful thing called a stop loss. A stop loss is pretty much a set point on an investment where you say, okay, I'm not comfortable with losing that much. I set mine to usually 5%. I'm okay with losing maybe $1,000 on trade if I'm doing however much 5% is of whatever that gets to $1,000. Can't think of it off the top of my head, sorry. But yeah, stop loss is a great thing, get amongst them. It will pretty much close a trade automatically if your stock is getting too low. The same thing happens with a profit stop loss. It's pretty much the same thing, but when you make a profit. So you can set it where you say, okay, I've made enough money. I don't really want to be greedy. I'm gonna close it, but I don't really use them because I want to leave the opportunity for market abnormalities to really spike up. And this is a great example of it. So say I'd done my analysis and I'd gone, okay, here's the first buy opportunity, first buy signal. I want to get in. I want to put however much dollars into this. It raises up exponentially up to this point, and you might go, okay, it's kind of bounced back down. This might be the opportunity to get out. However, if you have set your stop loss will be about, if you invested down here, be about down here, be closer to 1 cent, which would be fine, and you can automatically adjust it. So you would potentially stay in this trade. Just looking at this, the reason why you would stay at this trade is because it's not a spike. It's not a massive spike down. It's kind of a curve down. A curve down is not a clear indication. Anything with a curve is not a clear indication. Spikes are what we look for. So you've got a bit of a curve, and it's risen back up. That's great. That's good for you. Now, here's where things start to get a bit, how you going? So it's English, peaked. It has peaked again at this point here. Now, you might start to get a bit worried because it started to drop. Now, the reason why you shouldn't be worried is because you've got to take into consideration how much data this is taking into consideration. It's taking in 14 days. Now, the last few days have really been exponential growth. If you're going to have a few days of exponential growth and then just some days of down at 1 cent or 2 cents, and then you've gone all the way up to, say, 5, your data is not really going to be reliable. So what you want to do is you want to change your money flow index to a smaller number that considers just the last few exponential days. So what you can do here is, say it's at 14, you could change it just to consider here to here, and you get a much more accurate data set. And from there, you can make a pretty intuitive decision not to close the deal. Anyway, let's say we stayed in here. Again, it's peaking, and then you've got a bit more of a sharper downturn, and you've got it's time to get out. Like here, around here, when it's at almost 7 cents, that's your real indication to kind of to leave the trade. If you haven't left the trade by then, you still do have a time. However, it does still look like it's on a bit of a downtrend towards the end of it around here. Does anyone have any questions about this one? I know this one's I went on a bit of a sidetrack on this one. No questions? Sensational, moving on. This here, however, is a bit of an exemption. The money flow index does not work on everything. It works on pretty much stock only. So here we have the US Tech 100. This takes into consideration the top 100 top performing companies in America and pretty much makes them into an index. You'll notice how there's no data because it doesn't work. This is where you want to use your stochastics, your RSI, your MACD, and your other indicators. It might seem silly using an indicator that is so specifically set on one asset. I can understand that, and I do relate to that. However, I still think it's very valuable if you're just going to be trading on the Australian market. It's something that you can definitely use. If you want to be looking at, say, an American like Apple, it's something that you can definitely use. It doesn't really like putting together index, Forex, commodities, that kind of stuff. There are better indicators that can spot out opportunities in those ones, like your stochastics, your RSI, and there's some other ones that we'll go through later on. So yeah, moving on. Less obvious cases and introduction of the TRIX moving average. The TRIX moving average is a very unique indicator. It removes insignificant price movements. Now, could anyone just tell me why that might be useful? Why moving insignificant price movements might be useful? Doing the go. Yep, we'll go you. Yep. Okay. Do you have an idea as to why it might be useful? No. Okay. Well, we'll go back. That's fine. Okay. What we have here is an upward trend. It's clearly an upward trend. You don't really even have to have the data set, the money for MFI, to have a look at that and identify that it's an upward trend. This here, as you said, it's noise. It's insignificant price movements. So what this one does, it essentially removes it. It gets rid of it. It scraps it. It kicks it to the curb. You don't want it. And it will show you a very smooth, easy to read line that you can clearly identify. And we'll have a look at it right now. Oh, it's similar to the MACD as well, but not quite. Here it is. Did I say what its components are? I did not. I'm a genius. Anyway, moving on. So we have two lines, the 15-day moving average and the 9-day moving average. From memory, because the colors do change, I think I set the red one to be the 9. And no, I didn't. The yellow one on this one is the 9 and the 15-day one is the red. Sorry about that. Anyway, so moving on to what it actually is, I'd like you to picture in your head a football field for a minute. Pretend that this is the halfway point. This is where you're going to kick the ball. A player that's attacking, if they are closer to the goals of the opposition team, they're more likely to score, and vice versa. That's pretty much what this indicator does. It shows you what's likely to happen. And you can pretty much see that. If you're down here in this section below 0, so if you're in the negatives, you're going to be getting a fall. You're going to be getting a drop. You're going to get a downward trend, sorry. Similar going with the football explanation, it's the opposition team scores. If you're in the positive section, you're scoring, or the stock is appreciating. It's an upward trend. How can you identify this? Well, it just has to cross to the middle section. Now you'll notice here that there's a lot of green. So that means that there's slightly positive growth. However, this is below. What's going on here? Can anyone tell me what's going on there? We've talked about it twice now. No? Okay, that is divergence, actually. So what you have is, you have the candles showing positive, but the data set is showing that it should be showing negative. What's going on? The trend is weakening. And you can see that immediately. As soon as this crosses, there's that big growth. Now, what do these show? These little slightly shaded histograms. What do they show? They're showing pretty much, can everyone see that? Can everyone see that? I know it's light. Barely. Yeah, barely? Okay, sorry. I probably should have made it a dark color. But anyway, so I'll outline it. It's here. And then again there, and again there. What are they showing? Pretty much showing the strength of the trend. It's like an RSI histogram. It's pretty much exactly like MACD. MACD has a histogram which shows the trend strength, so does this one. How can that be useful? Well, it can be useful in this way. Even if you didn't pick up that was divergence, if you thought that it's just something random, or if you'd forgotten what divergence was, that's fine. Just that back on there, Doug, if you could. Oh, don't worry, man. Don't worry, it's fine. It's all good. Sorry, man. So if you didn't realize that this was divergence, what could you see? You could see that the histogram hasn't really taken off. The histogram is so small, it's pretty much insignificant. We shouldn't really even consider it. So what we're going to do is we're going to ignore that, and we're going to buy. We're going to buy on the assumption that the histogram is too small to be a considerable data piece. And we also have the divergence, and then what we would have done is we would have bought here, we would have continued to hold. There's no reason to sell. The reason for that is that the TRIX MA is still above that 0 point. It's still in the opposition's halfway. You're about to score a goal. You're in the process of getting it into the back of the net. Until here. Now what's happening here? You start to get a downward trend. But what's different between this downward trend and this one? Well, that's where your other indicators would come into play. And they'd be able to show you that the stock is actually really overpriced. Now, you might think that the stock is overpriced here, as it started a downward trend. But if you look at it, notice how this one is higher than that one. It means the trend is still going. Now, I do understand that some people might see that this has taken off. This is not insignificant data. This is significant data. So how can we identify that we should continue to hold? Well, you do what we did with the MACD. You change your numbers. Indicators are here to help you. They're not set in stone. They can be changed, they can be manipulated. You can have an indicator to tell you what you want to see. However, that's when you need to start being a little bit careful. If you start to make your indicators say that you're always in a buy when it's actually a short. So be wary about that, but most of the time, yes?
What's the lowest time frame you use as indicator?
Well, again, I can't really. It's hard to answer that kind of a question because You wouldn't go well anything above 5. I'd say anything. I'd be confident saying anything above 5. The reason I wouldn't be 100% confident saying everything as to say an exact number is because it would really depend on what the candles are showing. If you need to take into consideration that abnormal movement, you absolutely would change it to just show that abnormal trend. However, if you're looking at something that's a bit flatter, like this region here, you would have pretty much like absolutely no reason to change it. If you did want to change it, you wouldn't stray that far from the default settings. Does that make sense? Does that sort of answer your question? Yes, so was I. Oh, so okay, I'll read it. Are you you're talking about like 30 minutes an hour. Oh, sorry, my bad. That's complete my bad. Lowest I usually go is 15. I feel like anything other than 15 is too fresh data. It doesn't summarize it enough. I usually like to trade on the 30 just because it does kind of summarize it a bit more, and I find that more concise. An hour is pretty much the highest I go, unless I'm doing crypto. Crypto I do a day just because you need more of a day trend as to what's actually going on. Again, though, I would oscillate between the day, the half an hour, and the 15, just depending on what I feel like's going on. All right, so we're going to go into the Trix MA breakdown. So we have two components. We have the 9-day exponential moving average. Again, these use exponential moving averages instead of just normal moving averages, which is the signal line. And then we have the red line, which is the 15-day exponential moving average. Again, the most common signals are the crossover, same as MACD, the center line cross, and divergent. However, unlike with most of the other indicators that we talked about today, divergence is not that accurate with the Trix matrix, or with the Trix moving average. The reason for this is it kind of happens a lot. If you want reliability, you want something that happens less. It's something that's more infrequent. So I wouldn't really consider divergence as a potential strategy for this indicator, but I would definitely, obviously, consider the signal line crossover and the center line crossover. As we saw, they were very, very reliable. Anyway. There's an example of divergence. In this situation, it does happen to be a bit more reliable. But again, this is one of those unusual situations. And if you do look at the histogram, you're not getting that ideal trend in the histogram. It almost looks like in this region here, it looks insignificant. It's almost non-existent. It might be very hard to see on there, and I can understand that. I do apologize for that. However, it's very insignificant. It's a blimp. It's nothing. So I wouldn't really use divergence as a means of investment when you're using the Trix MA. Anyway, this is another example of I guess longer term divergence. So we have an upward trend, and it's quite clearly an upward trend. We're just connecting the peaks, and then we're connecting the peaks of this one. It's not massive. It's just a little dip before it actually continues to go back up, and that matches up straight away down here. You've got the crossover here, which tees up with this little point here, and then you've got the growth again. You could do short opportunities every time you saw the red line cross through the black line. You could do it there, but the money you'd be making is just not significant. You'd be better off, you'd really be better off waiting for this point here, buying there, and riding it all the way up. And you can easily identify that because of that crossover section there. Now, this is as I've done before. Did you have a question, sorry? Okay, now as I've done before, I'm just going to get someone just to quickly come up. Because it's a bit dark, I'm just going to ask them to come to my computer and then just use the mouse to show me. Who wants to do it? Anyone want to volunteer? Dude sitting next to Chad, was it? Yep. Up you get, man. Chad didn't have anything to say about it, so neither do you. Where would you get in? Where would you get out? And just tell me why. Or just come over here, man. It's a bit hard for everyone. It's a bit hard for you to see the histogram. Yeah, use the mouse, man. Go wild. Sure. You live your best life.
Say buy here. And
okay.
For no other reason than buy low and side.
Okay, fair enough. Fair enough.
What's this one showing?
Sorry?
What's this one showing?
Well, the Trix matrix is it removes noise. It removes insignificant price movements. Right. Okay. So what we're doing is you're not wrong. You're not wrong. You could absolutely buy here because that is where the trend is starting. That's the trend's original point. Yeah. However, where'd you say sell?
Up the top.
Up there. Up there. Well, that's actually very spot on. You would sell there, and that's just because there's a crossover. a good guess.
And what does it mean when the yellow and the red is crossing over?
The trend's over. It means that the trend is kind of changing. Okay.
Right.
And do you see how there's that little dotted lines through there?
Yep.
Okay, so that means that is your first confirmation, your first indication of a trend change. So there's two different types of things. There's confirmation and indication. So your indication occurs when it crosses through. Your confirmation happens, well, confirmation is pretty much that point. So you'd have indication, confirmation, and then you'd go. So just for everyone else, this would be indication. This is an indication signal, and then this is your confirmation. Very good job, I guess.
Confirmation's when it goes above the dotted line.
Yep, no, okay, so your indication as to what's actually going on with the stock is this point here. Is when they cross over. That's your indication of a trend change. Your confirmation doesn't come until this section here, and that's when it's crossed into the positive section, and you know things have actually started to happen. Yep, scoring goals. We want to be scoring goals always.
So you buy out the dotted line?
You could actually buy back here. This is where I'd recommend buying, just because there is a crossover. If you didn't buy there, your confirmation, like 100% get in, will be at the dotted line. Absolutely, absolutely. All right, does anyone have any questions? Okay, no worries. Well, first thing I'm just going to do is I'm just going to pause everything because I don't want my strategy to be going on. Prasan, you're always making me look like an idiot. Can you please stop doing that? All right, so we've been looking at OGX today, so I've decided to backtrack OGX until just before the exponential jump. So what we're going to do is we're going to add all the indicators, or as many as it will allow us. Could not complete. Let's just get rid of that. So we use stochastics. We also use the RSI. We use MACD. We use the choppiness index. And we've also used tricks. This is our data set.
Where could students get this indicators from?
Well, you just need to go to TradingView. I'll show the whole process. Sorry, that's my bad. This is why you're here, man.
Yeah, there we go.
Okay, so TradingView, www.tradingview.com. Let's just get rid of that, and then we're just going to type in our stock or our asset. You can pick up there. Before I go into that, one of the great things about this website is if you want to follow something and then if you're a paid member, it is free to use. I will stress that it is free to use. However, there's a minimum set of 3 indicators if you don't pay. I pay, so I can use 5. You can go up to use unlimited if you start paying like $30 US a month. I pay $20 Australian. I can use 5. I'm cool with that. So what happens is if you're following something, so I'm following oil. I love trading oil. So I've got 334 notifications about oil. So what happens is, what these notifications are, it will show you people or professionals that are posting ideas about it. They'll post their trend analysis, and then you can look at theirs. You can learn how they trade. You can also learn their ideas. What we also have here is just, again, people just posting their ideas about different stuff. So if you're into Bitcoin, you could look at this, guys. For whatever reason, if you are.
Top or pro, what's better? There's a few that go top.
Yep. So yep, absolutely. So I usually go with pro because they are professionals. Top is just people that have just got a lot of views. So just because you're top doesn't mean that you know what you're doing. You could just post something that's controversial, and people get a lot of views, and then that's how they could get up. You can obviously look at theirs. A lot of the time, some of the top people do post some very good stuff. Yes.
Does the site verify that?
Yes, absolutely, yes. So when you go to sign up, I'm pretty sure it does ask what you do for a job, and you have to apply to actually become a pro. Yes?
And I don't know if this is a dumb question. Do you
No.
need a broker or can you do it directly through the site?
Okay, so brokerage. You don't really use this website for that kind of stuff. If you do want to trade with leverage, I would use this website.
First of all, what's the difference?
Okay, straight away, what the difference is, this is just charts. This is analysis. This is a website purely based for charts. Demo trading as well can occur on here. You can do real life trading through this website, except it's a massive cluster to set up. So I wouldn't recommend doing that. It's too stressful. It's just easier to go to, say, IG, trade through them. So you do your analysis here, trade through these guys. Now, one thing I do want to stress is a lot of people have heard about the company Plus 500. Has anyone heard of that company? Don't use them. I was going to try not to swear in this, but it's a fucking joke. Plus 500, they don't have an Australian office. Customer service is ridiculous. These guys are actually in Australia, so if you call them, you will have a guy pick up and he will be able to tell you exactly what you're looking at. Very helpful. The day I signed up, I got a call from them just confirming everything and asking about my background and everything. If I need anything, yes.
How much is the commission for this?
Commission varies depending on what you do. Last time I checked, I think it was pretty reasonable. I think it was like 10 cents on the dollar or something like that. Though you got to be careful if you do long-term trades. They do charge overnight interests, which can get expensive. And if you do an overnight trade and then it doesn't go in your favor, you'll end up losing money and then you have to still pay that overnight interest. So be careful about doing overnight trades. So I would use this website, definitely if you want to buy and sell. I'd use this website to do your technical analysis. You can also get a lot of fundamental ideas from there. A great thing about this website is a lot of the headlines for that stock that you're looking at comes up here, recommendations comes up here. You can listen to the recommendations. Sometimes I do, but I always like to trust my own word. As I'm my own person. I like to believe what I want to believe. Anyway, so go back to this. Now, does anyone actually want to have a go at trying to do this? Just by themselves? Pasan?
No.
All right.
I'm a ghost. I don't exist.
Well, let's piss that off. All right. Why is it only showing one line? That's really annoying. Anyway, all right. Let's get deep into it. Now, if we zoom in, because there's a lot of useless data here. Let's look at stochastics first. What is that stochastic? It's 0.8. That's phenomenal. 0.8. That means the buy indication comes at 20. This is 0.8. If you don't get on this, you're an idiot. I don't want to say that, but it's ridiculous. Like when you start to get in stochastic values less than 1, you need to buy it. You have to buy it because when I press play up here, you'll see why. But okay, so let's go into RSI. The RSI is not too interesting. It does sort of back up the stochastics. There's no divergence. It doesn't really say that it's overbought or oversold. The trend is saying that it's kind of continuous. There's not a lot of noise going on. It's pretty standard. If you looked at the RSI for this, you wouldn't think that it's that great. Moving on to the MACD, you've seen that there's a crossover here and there's an upward, very slightly upward crossover. However, it's still negative. That's not a clear buy signal. Look at the choppiness indicator. It's about halfway. It's stable. Nothing really exponential is going on. There's nothing really saying we should 100% buy the stock. Next, we're going to go on to the tricks. The tricks is negative. For whatever reason, it's not showing the other line. I'm not really sure as to what. I'll try and fix that, sorry. This is just the same graph. I've just brought it up on a separate thing to see if there's an error in something. But I'll try to bring up the tricks with it proper. Why is it doing that? Maybe it's the tricks. Oh, it's the tricks MA. That's right. There we go. Ah, that's much better. And I'll just clear this up. So if you do use the free version, unfortunately, you can't do this side-by-side analysis stuff. It will only let you do one graph. If you do want to go crazy, for whatever reason, you can get it up to when you got 8. But I think that's a bit ridiculous. Unless you had like a massive projector screen like that, and you could separate it, that could be useful for you. I don't really know. Anyway, so looking at this, we kind of have a little bit of a cross. So that's kind of an indication. However, it does look like the trend is starting very slightly on the downwards. It's so hard to see, and I really do apologize for that. But it's insignificant. Now, so the only indicator that we have here saying to buy is the stochastics. The stochastics is saying, that's such a mouthful, stochastics is saying that it is grossly undervalued. So with this, could I just get a show of hands? Buy. Yeah, keep them up so you just know. Okay, 1, 2, 3, 4, 5. Five people. Who reckons sell? Good choice. Who reckons don't get into it? All right, let's have a look. Go back to this one. Let's have a look. What's going to happen? See, it started to jump, and then it's jumping, it's gone. Now you notice, at this point, your stochastics is telling you to sell. Why wouldn't you sell? Your MACD is telling you don't. Your choppiness is telling you that the strength is strong. Even your RSI is telling you somewhat to sell. At this point, what would you do? Who reckons stay in it? Who reckons it's time to short? Okay, who reckons that because you didn't get in before, who reckons get in now? Okay, no worries. Good contribution, guys. Right, so we did get a little bit of a drop. Let's just see if we can speed this up a bit. So, pause, stop playing. Stop. All right, it's doing its own thing. I'm just gonna let it run. It doesn't know what it wants. Oh, it's up to today's date, is it? No, it's not. Anyway, so as we can see back here, when I asked you all, what should we do? I reckon that we should have stayed in it, and I did. That's why I got up to, I think, 13 cents. You don't really get your first indication from the MACD to sell until you get this crossover. Even your RSI, it's dipped back down. So all here, it was kind of telling you to sell, but it wasn't really sure what it wanted to do because it bounced up and down between it. Your stochastics, again, it's telling you potentially to sell, but it is, again, it's bouncing. It's not clear. It's not concise. It's not telling you this is what I want you to do. So what do you believe? Believe the MACD because it's the only one telling you something clear. It's telling you what to do. Everything else is kind of noisy. You can't see anything clear. If something's not clear, don't get into it. Don't do anything. Set your stop loss so that you can confidently stay in the trade. So you can go to bed at night and not have to worry about getting up at 10 a.m. and checking the market to make sure that you haven't lost money. So where would you set your stop loss? Say you're trading here. Where would you set your stop loss? Well, personally, I'd set it here at 8.7. So it's at 10.7. I'd set it at 8.7. Reason? 2 cents. What's 2 cents on the dollar? What's 2 cents on each share? It might be a lot if you've invested, say, $100,000, but overall, you're still going to be making a ton of money. So it doesn't matter. But you have that chance to continue to make money, and you also have the opportunity to prevent an exponential loss. Now up here, when we're starting to get towards the peak of it, what can we see? We have the MACD confirmation, which is here. We have the choppiness index saying to us there's going to be sideways movement, which there sort of is. It's not 100% sideways movement, but it's not moving in a clear direction. So you've got your MACD telling you it's time to get out. You have your choppiness index saying we're about to hit sideways movement. You have your RSI dipping into that section where nothing's really occurring, but it's dipped down. So that means that short opportunity did exist back here. That's where you would have made the most money if you shorted back here. Your stochastics as well is saying the exact same thing. So what would you do? You short it, obviously. And that is how you use all the indicators to pretty much make a concise decision. Yes? It did, absolutely. So why wouldn't you sell here when it crosses?
Yeah.
Okay, well let's compare. Compare the pair. Same market. Okay. So let's just let's look at this section here, and then we're going to compare it to this section over here. So how would you describe that MACD cross? How would you describe it? Just look at it there. How would you describe that? It's flat, is it not?
Yeah.
It's not as dramatically downward spiraling as the other one. So that would be your first indication if you didn't use any other indicators. You'd look at it and go, well, all right, it's crossed, but nothing's happening. It's not crossing and dropping. It's just crossing but flat. So nothing's going on. It's not a clear indication again, so you wouldn't do anything just looking at the MACD. You look at the RSI. Well, you've missed your short opportunity, so you don't know what's going to happen. So you wouldn't get in. So let's go to our stochastics. Again, you've missed your short opportunity if you were to short it, so you wouldn't short it. Let's go down to our choppiness. Choppiness is saying sideways movement. So you've got two things saying sideways movement. And I'll add the tricks matrix as well. Sorry, I didn't realize that wasn't there. We're gonna have to, yeah, there we go. Okay, so we're looking at this section here. So even your tricks matrix is kind of saying that there's a bit of a cross, but again, it's not that exponential downward turn. It's not that huge of a trend to say, hey, wake up, short. It's saying, hello, it's happening, but I don't really know what's going on. So if you consider all your indicators, nothing really is actually telling you to sell. Nothing's telling you to get out, and nothing's telling you to buy more. So if nothing's telling you to buy and nothing's telling you to sell, you stay. You set your stop loss to guarantee that you don't lose ridiculous amounts of money, and you just continue watching it and continue making money. That's all you do.
How long would you wait after it crosses for you to know if it's going down?
Down? Usually I wait 2 hours. So whenever I see an indication of something, 2 hours if I'm using the 30-minute. Sometimes if I'm really nervous, I'll wait an hour. Or I'll change the timing between 30 to 15 to 5. 5 is when I'm really nervous about something. I would never go lower than 5 just because that is going to be getting too wild. Now I believe you had a question as well.
If you were to trade for a few months,
Yep.
would you be concerned with fundamentals, or would you still 100% rely on?
All right, so the difference between, okay, so there's trading and investing. They're not the same thing, they're very different. Trading is when you're doing a few trades a day. That's trading. Investing is when you wouldn't use leverage for investing. You'd go to ComSec and you'd buy through that because when you're doing long-term trades, let's say you did decide to long-term trade this for whatever reason. If you bought in here, back in on the 9th, well, I guess actually this would be a kind of an invest, I guess you're saying then, because you're talking about months. So let's say you did get in here. If you weren't using leverage, which I wouldn't really recommend if you were doing investing, you buy in here and you continue to wait. You could use your technical analysis. Fundamental analysis is okay. It will tell you what's going on with the company. However, one thing you do need to take into consideration, I did kind of bring this up at the start of the class quietly to the people in the front. Let's say you've made a pie. You've gone and spent the time baking a pie, and then someone asks you, what's the pie like? Are you going to tell them that it's shit? No, you're going to tell them it's the most amazing thing in the world. That's what investors do. They think that the stock they get into is the best stock. The best example of this is a company called ASN, which I will actually bring up now to prove a point. So unfortunately, I did believe the hype on this one, I'm not going to lie. I didn't do my technical analysis like I should have. I believed a tip from someone that was already heavily invested in this one. And that was a big lesson for me. Don't do that. Fortunately, because of stop losses, I didn't lose that much, but I still lost, and it doesn't make me happy when I lose money. So what was happening was, around here, the stock is at 27.5 cents. Looking just at the fundamentals, so ignore that. Fundamentally, they were coming out with an announcement within the next few days. The announcement was supposedly to be something about them finding a new iron mine vein. It was supposed to be a massive one of the biggest ones in the world. Blah, 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 blah. It was supposed to be great. They delayed it. Now, what happens when companies delay announcements is people go, why are they delaying it? There's a lot of speculation. There's the ambiguity. Investors, traders don't like ambiguity. We like certainty. We want to know the numbers. We want to know what's going on, when it's happening. If there's a delay in something, you move on. I didn't because I'm stupid. So I got in at 27.5 cents. And my friend was telling me, oh, it's going to be the biggest announcement ever. And I was reading up about it. I was reading things on Hot Copper, which is an investing forum. People post what their opinions are on a stock. However, you have to be careful. Most of the people that are posting on Hot Copper are people that are actually invested into it. So what I did was I believed the hype. And I thought, yeah, this is going to be a great thing. It's going to go from 20 cents to $3 or whatever. That was stupid. That was ridiculous. I should have done my technical analysis because I would have seen immediately, like, just look at your MACD. There's a crossover straight away, like a day after, not even before. Like, immediately you can see here, there's a crossover. That would have been an opportunity. Opportunity to get out. Opportunity to get out. Opportunity to get out. Opportunity to get out. There's 5 indicators telling you to get out. This is where fundamental analysis is a problem. People believe hype. People want to believe that their stock is the best. That's why I don't like fundamental analysis, because it's ambiguous. News reports can be swinged to a particular way. Company reports, not so much. If you're going to go and look at accounting statements, I'd say probably don't. You're a university student, and I don't mean this to be derogatory. You're a university student, settle down. You're not someone from CPA that's been doing it for 30 years. You're not going to find something that hasn't already been found. And I really do mean that, because I've spent hours looking at financial statements thinking, oh, they've missed this. Oh, I've got the insider trade. No. If it's on there, someone's found it, someone's thought of it, someone's realized it's stupid. Move on. Fundamental analysis can happen for long-term investments, obviously, but I'd still consider technical analysis. I'd just change your numbers to consider more data. That's really all I'd do. Yeah, as you'll find out through this whole course, I have a big problem with fundamental analysis. All right, so does anyone have any questions about this one? Any queries, any inquiries? Yes?
Yeah, are you able to explain why you would be in the RSI chart?
Say that one again, sorry?
Why did you say you would sell according to the trend on the RSI?
Okay, on the RSI, no worries. All right, so I said, well, the sell opportunity is quite clear here. You do have that downward trend. It's gone back into that, that 75, 25 zone. If you didn't, that's still fine. You still have a few other indicators which are going to take their time. So you've also got the tricks, which is down here. You've also got the MACD, which is there. Your stochastics is kind of showing there. Even if you didn't, you'd have a stop loss, which would close the trade, which would save you from actually having to do it manually, which is great. Gotta love it. Yeah, so if you're looking just purely at the RSI, it's not exactly a sharp turn down. I would say it's in between sharp and a curve. So it's not a clear indicator, but it is definitely giving that hint at trying to get out, because it's gone back into that area where you don't really want to be in. Does anyone have any more questions? We'll go do in the red and then we'll go do at the back.
Do you have a rule say like 4 of the indicators have to say the same thing?
No, I try not to set things like that, because there are situations where you'll get 3 indicators saying the one thing, but then there'll be 1 indicator saying something completely different, and it'll be so extreme that it kind of cuts out the rest. So if you looked back at OGX, I guess this is an example of that. So you've got pretty much every single indicator except maybe the tricks telling you that it's not an ideal time to invest. So if you did that, if I said, oh, okay, 2 indicators saying this, I'm not going to get into it, I probably wouldn't have gotten onto this, and I would have missed that opportunity. So what I do is I'll look for extremes. I love looking for extremes and market abnormalities. I think that that's probably one of the best ways to trade. Instead of looking for slight things, I'll look for market abnormalities. So in the last 6 months, I've only done about 30 trades. And most of them have been about a day or 2. Just finding those market abnormalities is pretty much what I look for, and then I will go really heavily into them. So one of my biggest trades was, I think it was $12 million into Europe. It was on a 1 indicator telling me something, and it was at such an extreme that I went, okay, I want to get into this, and it worked pretty well with me. The same, I'm more of an index trader, so I like looking at the Japan 225, the ASX 200. I know I might cop a little bit of crap for this, but I love trading in Greece. I know most of you might laugh at that, but Greece is volatile, and if you're moving up and down $500 a day, that's where you want to be. Like this, the whole index is only worth about $2,000. But if you're moving up and down about 300 points or something ridiculous like that, that is an index that you want to be in, because you can take advantage of a 1 to 300 leverage. It's like trading a stock, but except you have a ridiculously more like higher leverage amount that you can do. So you can do a 1 to 300 trade, pump leverage $4 million into Greece and make $300 per share. And that's where you start to make your 200 grand trades, your 300 grand trades, and so on and so on. So that's how I trade. I look for market abnormalities. So that there, and with stochastics, that is something I would deem a market abnormality. I've just got that guy, and then I'll go to you. Yes?
Just a few minutes ago, you were making the case that we shouldn't bother with fundamental analysis accounting statements because there's other people that are going to pick out that information.
Yep.
Could I make the same argument that I'm not going to make any money using technical analysis because there are smarter day traders out there that are feeding me to the information?
Well, okay, yeah, you could. Absolutely, I do see the point. And maybe I should have chosen better words. Fundamental analysis, I wouldn't say is completely pointless, but you can absolutely still trade on fundamental analysis. It doesn't matter if there's 100,000 other people doing the same thing. You can be one of those 100,000 people. As long as you're making money, that's fine. My issue more with fundamental analysis is when people start to believe the crowd. So I guess the biggest, most recent event regarding crowd issuing would be Bitcoin. People believed that it was going to hit. I was seeing reports of it hitting, people thinking it was going to hit $100,000 in valuation. Like, the average person that doesn't really know much about investing will believe that. They'll go, oh, it's only $20,000 US. Let me just put my entire life savings into it, and when it hits 100,000, I'll be sitting on the Bahamas doing XYZ with my beautiful wife. No. Don't believe the hype. Do your own technical analysis. Technical analysis doesn't lie. It might be sometimes a bit ambiguous, but that's why we have different types of indicators. We have a huge variety of indicators to show you different opinions, different opportunities. Technical analysis is just technical analysis.
So even if other people are doing it and...
You can absolutely do the same thing.
You can still do it.
Absolutely, why not? Like, say you and I are doing the same trade. We're both going into this company, OGX. I might put $10,000. You might put $100. We're both buying at the same time. We're both using the same tools. The only difference is one person's putting in more than the other. That doesn't mean you shouldn't ignore the opportunity. You should absolutely take every opportunity you see. It doesn't matter how much money you're putting in.
Let's just say there's like $1 billion hedge funds around the
Yep.
world, and they're doing it probably much quicker than me because they've got better software than computers.
Yep.
And when they're pouring millions of dollars into certain shares,
Yep.
wouldn't that force the price to go up, for example, if they're buying? And that means once I see it, the price is already too high for me.
Okay, yeah, that's a good point. So what we have is we want to really identify the opportunities before. So there might be, say, JP Morgan's seen this stock and a guy at JP Morgan's gone, shit, let's put $1 million onto it at 10 cents. That's ridiculous. They're going to make stupid amount of money. But if you look at the data, you can actually see that there's the opportunity to buy back here, just using stochastics. It doesn't matter who you are. And I can give you an example of that. Let's say I open a chip packet and there's someone who has a bit more weight to them. And I'm trying to be as sensitive as possible, but this is the best example that I can think of off the top of my head. This is the best example. Okay, okay. I'm trying to do the best I can. So let's say someone is a bit bigger. There's a chip packet, one Smith's chip packet. They might take 90% of the chips, and you're this bloke. You might just come in, take 1 or 2. You're still getting some chips, but not as much as them. That's the same example. You get these big companies investing in it. They're making ridiculous profits, but you're that small one that's just coming in, doing the quick trades, the quick 1, 2. You might be putting in $100, but you're still making money at the end of the day. It doesn't matter how much money you make, as long as you make money. Does that make sense? Okay, cool. Now, you had a question?
Oh yeah. If you leverage your money and like most of the graphs you were showing were over like a few months for the stoichiometric graphs.
Yep.
For it to go positive, wouldn't you end up paying more in fees than the percentage you're making?
Depends how much you're investing. So usually your interest is about maybe 2%. It's usually sometimes around the amount that the banks are charging. But say you do leverage and you're borrowing $1 million or something like that, 2% of $1 million over 3 days, because this daily percentage might seem like a lot. But as long as you're making positive amounts, it's going to be fine. Like if you invested $1 million down at 1 cent and you wrote it all the way up to 13, that's 13 million. There's no way you're going to be paying $13 million in interest, you know?
But most of your graphs last over like a month or 2.
Yep, and that's
60 days with 2.5%.
Yep. Yeah, I do understand where you're coming from. However, there are a lot of opportunities that do exist where you wouldn't need to do that. For example, I might actually have one here. What's this? It's 20 cents. Okay, so let's take this opportunity here. The trend has already started, so it's probably not the best time to get in, but let's say you did. Going on that, you've got a rise from 16.5 up to 20 cents, 22 cents. That's 6 cents on each share. Might not seem like much, but if you've invested quite a lot of money into it, it's going to add up really quickly. If you hold it for one day, because that's what it is, it's on a one day, you won't be paying any interest. But let's say you decided to hold it up to here. Now, that's on the 15th, and then that's on the 5th. You've got 10 days. You won't be paying as much money as you make. And depending on how much you're willing to borrow, will obviously affect the amount of interest repayment that you do have. But usually, it's very rare that the money that you make, as long as you're correct, will be taken over by the amount you borrowed in the interest repayments. Does that answer your question?
Yeah.
Okay, cool. Does anyone have any other? Yes.
What is your usually trading days? How long do you hold a share?
How long do I hold a share? Well, it's hard to answer a question like that because I hold a share as long as the opportunity exists. The longest I've held a share was for 2 months. That was an Australian share. I believed in it. The data was good. I continued to hold it, and then I exited. There's been trades like, unfortunately, a Seadrill. There was an opportunity with Seadrill. I held the stock for about a minute, made $10,000. Unfortunately, it's... the issue with bringing the graph up is this is the graph. You know what you are. All right, so let's give a bit of background. It's the Seadrill. I bought 1 million shares in Seadrill when it was worth 20 cents. It went from 20 cents to 60 cents. I made quite a bit of money, and then it dropped. It then went from 40 cents to $20. And how long is that over? That's over 2 days. So let's have a bit of a look at this wonderful graph. So this is on the 2nd when the trend is where it's peaked. That's on the 6th, 4 days, and it went from 10 cents to $21.53. Now, there is a reason why this happened, and you do have to do a bit of fundamental analysis to understand why this happened. A few months before this, Seadrill they were actually facing administration and facing bankruptcy. I might be able to, yeah, here we go. So this is Seadrill. When you look at it, pretty pathetic stock, and this is something that I'm actually going to point out throughout the duration of this course, is just because a company is facing bankruptcy doesn't mean you can't trade it. It's riskier, but the rewards are much greater, as you can see through this. So they went from about $50 back in 2013. For whatever reason, they didn't do so well. They gradually dropped down all the way to 30 cents. You go to cents, like useless stock. It almost looks useless. What happened then was 2018, about a month before the, what's that thing where people hand out group certificates called? Financial, that's the one. Sorry, brain fart. Anyway, so about a month before then, they went to the American Bankruptcy Association, I believe that's what they're called, and they submitted a new report, the new financial report as to what they were going to do to improve their position. It was approved. That's massive. That's massive for a company facing administration to be approved by a government agency for their new pretty much strategy for the 2018 onwards. That shot the stock up price from about 20 cents to 60. So already that's an exponential growth, and I got onto that, and I thought that was pretty much the end of it, and I couldn't believe that it would go above $1. So I got out. Then what happened was the financial year came around. They must have done. I only just found out about this today, so I don't know too much about what actually caused it. But this is my speculation: is that when their financial statements came out, their earnings was about average. Investors got onto it, and they really pumped up the price like no tomorrow. And now it's worth $20.08. So The opportunity, just in case anyone's wondering, was about $20 million loss in opportunity cost. Just wondering if anyone was wondering. I was wondering, and I'm very salty about it. But anyway, that is Seadrill. So it does pay attention to shop around every day. So what I'll do is I'll usually start the day and I'll go and I'll just look at random stocks. In each country, I'll look at different indices. I'll look at different Forex and commodities. And pretty much that's basically how I trade. I look at what's been the biggest riser, what's been the biggest faller, and go from there. Now that can actually be done, and even though I did say I don't really like plus 500, plus 500 actually does do one thing that's really good. So that's demo account. We'll go to trading and rises and fallers. It's always set up, always have a demo account running so you can test new theories. This is great. So what this thing does is it shows the big, it doesn't discriminate either. It shows index, commodities, Forex, options, calls, everything. And it shows you the biggest rises and the biggest fallers of the day. So you've got this one, 138% in a day. In a day, that's ridiculous. Anyway, so you continue to go and it will show you, and then it eventually goes to the most dramatic falls, and you can pretty much see what's going on. And from here, this can pretty much help you form an idea of what you want to be trading on a particular day. It can help you identify market abnormalities, and you can pretty much go from there and really dive into the trading that you want to do. So I guess that's it. Yeah, that's first week.